All right, for more on CPI and that housing number, let's bring in Intercontinental Exchange's Andy Walden. He's the VP of Research and Analysis. Andy, great to have you with us. So a lot of the, going into this number, there's so much expectation that the shelter component would come down based on the private sector surveys that we had seen. If it was so well known that it takes a year for that to read and go into the data, why wasn't it expected that they would not come down?
It's a good question. I mean, you're right. If you look at any of these other numbers out there, you look at the true rent numbers, you look at the latest ICE home price index, it says home prices have been cooling for the last 5 months, and we saw our coolest reading in the last 12 months. And so there, as you've mentioned already, there's some wonkiness in that number and the way that it's calculated, certainly a lagging indicator in terms of what's truly going on out there in the market.
Andy, if I look at housing overall and I hear some of the comments from what we've heard on the credit side from the consumer over the last couple of days, we're talking about auto loans, we're talking about student loan delinquencies. Can you just give me some sense how this is playing in? We've heard certainly from the builders themselves. We know where supply dynamics are for the market, so we know there should be a bid to the housing market. But we have not really gotten to the side of the strength of the consumer and the housing balance sheet.
Yeah, when you look at delinquency rates, they're still historically very low. They're a full percentage point below where they were in the early 2000s. They're a full percentage point below where they were kind of leading up to the COVID pandemic. In recent months, we've hit a nearly 20-year low in terms of seriously delinquent mortgages, and foreclosure activity is through the floor right now. And so really when you look across the board, you're not seeing a whole lot of concern. Now, the one area that we do have our eyes on are more recently originated loans, where we know that folks were stretched from an affordability standpoint. Debt-to-income ratios were higher. We're also seeing a modest rise among, some of those FHA and VA type mortgages that are more entry-level buyers. We're certainly seeing some gradual rise in delinquency rates there that we expect to be kind of the early indicator for the market this time around. But broadly speaking, you're still seeing very low delinquency rates in that mortgage space.
How do you think through the drop that we've seen in mortgage rates? I mean, mortgage rates now are at their lowest, I think, since February of 2023, given the strange sort of supply-demand dynamic that we have here. A lower mortgage rate doesn't necessarily mean it. I mean, how do you sort of factor that into housing prices?
Yeah, you're absolutely right. And if you look at the mortgage rate yesterday, it was 6.2% compared to, according to our in-house ICE data there. That's down 0.5% from where we were at the end of July, down 1% from where we peaked out in May. So it's certainly moving the needle from an affordability standpoint. And anytime we've seen rates fall like that, you've seen a corresponding return in demand. And so I think that's the big question mark. From a home price perspective, we've been in a cooling cycle this year. The question is, does that speed things back up? And when you look at purchase loan applications, when you look at purchase rate locks, we've seen 4 of our strongest weeks of this year here over the last few weeks. But it hasn't been as strong of a reaction as we saw even early this year when rates fell to a higher level, or more specifically in early 2023 when rates fell below where they are right now. We're not seeing as strong of a response. And so we may see some firming of prices. I'll have my eyes on inventory data when it comes in for September to see if this starts to buy down inventory levels. But I wouldn't expect as strong of a reaction as we saw in 2023 when rates fell and the housing market significantly sped back up. But again, that's to be seen here over the next few weeks and next few months out there in the market.
And despite the fact that the unemployment rate's gotten up to 4.2%, it's still pretty much at historic lows. What is the rate where the housing market starts to take notice?
I think you'll gradually see that impact both mortgage performance, mortgage delinquencies, as well as demand out there in the market. I don't think there's a true trigger point in terms of seeing a cliff there. But obviously, one of the key components to being able to afford to buy a new home or afford the mortgage on your existing home is having a job, right? So there's kind of this corresponding impact. As unemployment rises, you're going to see both of those metrics impacted. But I don't think there's a cliff point where we get to a certain point and you see a massive incremental impact.